Well, welcome back. We're watching oil this morning. Take a look at where it is. Below 60 now at 58.73. Crude dipping as U.S. shale companies churn out at record rates. Joining us right now to talk more about that is the Schork Report publisher, Stephen Schork. Stephen, good to see you.
Great to be here.
We were just reading the Journal story that, output is so strong, there are questions if it's actually going to meet demand. Energy observers are projecting this pace could overwhelm global demand. What's your take?
Absolutely. I'm on board with that, Maria. Production is at record highs, and it's going to continue to rise. We have hedges by the producing companies that have been at record highs. They've been hedging this rally since the fall. We also have a very strong correlation in the 4-month lag in rig counts and the rise in oil prices. And given the sharp rise in oil prices over the last 6 months, rig counts will continue to climb well into the summer. So absolutely, supply should outweigh demand. Keep in mind that demand is, excuse me, yes?
Steve, it's Mike Murphy. I just want to ask, we're talking a lot this morning about inflation and the price of goods going up. Is there a scenario where you see strong numbers from the economy, numbers that are so strong that we push oil back up through the 60s, say north of $70 a barrel?
I think that is indeed a possibility, Mike. I don't think we'll stay up there long enough. The demand elasticity for oil will still remain quite strong at $70 a barrel, so I certainly wouldn't rule it out. I do think, as I think I was here last week, I do think mid-60s, high 60s is the top of the market. I don't think the producer wants oil prices that much higher because all that does is invite more substitutes in the market. And that brings me on to demand. While demand is strong, I do not think it's going to outpace supply simply because of two events. We have the response by the substitutes, electric vehicles, of course, and the greater efficiency. Just an anecdote that I could drive from Philadelphia to Charlotte, North Carolina in my diesel SUV on 1 tank of fuel. So indeed, we're stretching out the BTUs much further, and supply should continue to outpace demand.
Stephen, Mitch Rochelle. I was just down in Texas, and I was talking to some of the shale folks down there. And one of the interesting things about shale is they can turn it on and turn it off, unlike rigs that take forever. Is there a price at which they're just going to stop production? And how's that sort of balance going to work?
I think that as long as we hold in that mid-50 range on the bottom of any sort of pullback, we'll still see solid production. It's not until we get below $50. Most of my clients that subscribe to the daily report on the producing side are comfortable with oil prices above $50 a barrel. But you start to see a 40 handle on oil prices, you certainly will start to see production pull back. But keep in mind, it will be a tremendous lag because of the tremendous amount of hedging that these producers have done over the last 6 months.
And then there's Venezuela, right, staring down the barrel of an oil crisis. The country's production fell to the lowest rate in nearly 30 years, Stephen. That was just last month, despite having more crude oil than any other country in the world. Secretary of State Rex Tillerson weighed in on this last week, saying that the administration is still considering a ban on exports for the country. What does that say? Put Venezuela into the mix here.
Yeah, absolutely. And every Bernie Sanders supporter out there, please take note of the inevitable outcome of socialism. Venezuelan production is now less than half it was in the late 1990s before Hugo came in and started that country on its long decline. So right now, exports are down to about 1.6 million barrels a day. 1/3 of those exports go to the United States, and another considerable fraction goes to China and Russia for repayment on debt. So you cut out a third of exports to sell to U.S. companies. Venezuela is in absolute dire straits right now.
Wow. Yeah.
And we can, Stephen, it's Dagan McDowell. We can handle it, though, as a nation. Given what's happened in our country, we only import, think back in 2006, we imported about 13 million barrels of petroleum product and crude oil every year, broadly speaking. Now it's just 2.5 million. We're very, very stable and virtually independent.
Partly because of the shale revolution.
Right.
Yeah.
Absolutely.
Yeah.
Yep.
Yes. So, and just keep in mind, there are 4 refineries in the Gulf Coast of the United States that import 54% of the Venezuelan oil. So these 4 companies, Citgo, Valero, Chevron, and certainly would be having to search for about 280,000 barrels a day of oil should the ban occur. So the United States would easily counter that with the release of barrels from the SPR, allowing these refiners to source oil from other countries.
All right, we'll watch that. Stephen, good to see you, sir. Thanks so much.
Great. Thanks,
Stephen Schork joining us there.